G'day, I'm Lachlan Maddock and I'm joined now by AXA IM Rosenberg Equities Chief Investment Officer Gideon Smith to discuss AXA's unique approach to sustainable investing. Gideon, thanks for joining us all the way from England today. How are you?
I'm very well. Good morning or good evening.
Good evening here. Good morning to you. And again, thank you so much for rising early to give us the rundown exactly on AXA IM's approach to sustainable investing. Maybe we can take it from the top. Can you tell us about AXA IM's sustainable equity strategy and what it seeks to achieve and how it does that?
No problem. So ultimately what we're trying to achieve is what every active manager would seek to do, and that's to deliver better returns in the market. And I think this is key, we want to do it in a way that lets you sleep soundly at night. Now there are two things that help me sleep better. Firstly, I think it's knowing that the portfolio I'm investing in is made up of sound, decent, responsible companies, companies that might benefit from some of the broad themes that are shaping society, but also companies that are going to go on and deliver benefits to society, well-run companies with strong governance and sound social and environmental policies. And then the other thing that lets me sleep well at night is not too much excitement. We like to buy boring stocks that generate a stable stream of earnings, not too much risk, not too many surprises. So in order to achieve this, what it means is that we really emphasize three factors or considerations when we're picking stocks. Firstly, we want to buy low risk stocks, companies that don't exhibit too much volatility. Secondly, we want to buy high quality stocks, companies with stable, repeatable, sustainable earning streams. And finally, we want to buy companies with attractive ESG credentials, companies that score highly in terms of environment, social, governance features, companies with significantly lower carbon and water intensity than their peers. And so if we are able to do all of this right, if we manage to achieve all three of these things, then I get to sleep well at night.
Now, it's interesting to me you say that because it seems to me that the scene over there is much more developed than in Australia in terms of ESG offerings, that there is, a proliferation of companies that do all three of those things. What is the landscape like in terms of ESG and regulation to ensure that it's integrated into these companies?
It's an interesting question. I think I'm not sure I'd concur that things are so much more advanced here. I think it's increasingly a theme across all markets that there is this focus on responsible investing and ESG. I do think there are some particular themes that stand out in the Australian market, particularly related to climate change or more directly impacted by the effects of climate change, and also the makeup of the market there is very, very, very focused on things like coal production, oil and energy. And so that does lead to a certain focus. I do think that European regulators have become more interested in trying to regulate the responsible investing space, and that's led to a proliferation of RI labels that the companies have to comply with. What's interesting to us is how those vary across markets. So in some markets, clean energy might have a focus on nuclear, and in other markets, clean energy might explicitly exclude nuclear. So it becomes quite challenging as an investor. Nevertheless, I do think that this is being led by clients and fund managers more so than regulators, and I think that's true both here in Europe and in Australia.
Yeah, absolutely. I think you're bang on the money there with that client-led kind of pivot to ESG, although the regulators are now in Australia stepping up a bit of their interaction there. Why does the strategy particularly focus on low volatility and high quality factors?
So I think one of the reasons we focus on low volatility and high quality is simply a desire to avoid excitement, to buy those stable, boring companies. But more than that, I think focusing on low volatility and high quality actually tells us something about the fundamentals of companies. It's not enough for me that a company's share price is stable. I want a company's earnings stream to also be stable. It gives me a fundamental anchor, and it connects earnings to prices, to strong, repeatable investment outcomes. So what's particularly attractive for us about this combination of factors is that they actually allow you to deliver performance across the market cycle. Most people would expect the low vol factor with its defensive characteristics and lower beta to provide downside protection when markets are falling. But what the high quality factor allows you to do is to also participate when markets are rising. So for example, right now, some of the biggest holdings in the portfolio actually include some technology companies like Apple. who may not be considered the most defensive of plays or having a particularly low volatility in terms of their share price, but they do score highly in terms of their earnings quality. And it's this factor that then allows them into the portfolio. And it's these types of stocks that help performance as markets, and tech stocks in particular, when they come back strongly following market falls like we saw at the start of 2020.
Now, in previous conversations with some people from AXA, they've pointed out that AXA has actually kind of been riding the ESG train for about 20 years, so very much ahead of the curve there. Why has it been so fundamental to your investment approach for so long?
So on the one hand, I think these principles, ESG, responsible investing, are perennial ones. And when I say that, it's rooted in our investment philosophy. We focus on these concepts for so long because we think they're essentially economic in nature. And so you should, of course, consider them within your investment decision-making. The governance of a company, its sort of impact on the environment and on wider society, these issues have an actual impact on the economies of the business, the economics of the business. And so ultimately, we think it impacts the earnings that a company can generate. And that's why we see it as core to our investment approach. But I do think there have been some forces that have caused us and others to pay even more attention to them in more recent years. I do think there's a growing awareness of the importance of responsible investing principles, that companies' activities have an impact on society. And that awareness amongst shareholders, customers, regulators, investors, we're all increasingly conscious of that. AXA Investment Managers benefits from having a very large insurance company as a parent. And so they've been instrumental in helping drive that awareness. As an insurance company, they, like all of us, bear the costs of societal change, the impact on the environment, of food inequality, or the impact of coal and energy production. And that focus has driven us to proactively push these principles into our clients' portfolios, even before I think there was necessarily demand for it. A second thing that's particularly pertinent for us is that of the ever-increasing volume of ESG data that's now available. We're a quantitative manager who voraciously consume as much information as we can. And as I said, I think this information is ultimately economic in nature. Better data, better information leads to better investment insights. Better insights lead to better investment decisions, and ultimately, hopefully, better outcomes for clients. I can give you an example of how we use that data. When we value a company, we try to look at all of the activities on a company's balance sheets and estimate what they're worth. But not everything a company does is necessarily included on its balance sheet. So, for example, we believe that a company's carbon impact creates a real cost to society, and at least some of that cost is going to be borne by the company itself, whether that be through taxes or regulation, or simply consumers choosing to take their business elsewhere. Now, that cost may not appear on the balance sheet, but there are carbon data sets that we can use to proxy it and then actually adjust the valuations we calculate. When we launched the Sustainable Equity Fund back in 2014, it was one of the few funds that actively emphasized the ESG considerations embedded in our approach, not just negative screening, but actively considering the impact companies were having and then tilting the portfolio to emphasize those positive characteristics. And I think it gives a sense of the journey we've been on as investors. We've always taken ESG into account ever since I joined the firm over 20 years ago. But initially, that was much more focused on exclusion and divestment. Over the years, that's evolved into a more activist approach as we've found ways to integrate it into the heart of our investment process, including it in signals and considering both positive and negative factors when we pick stocks and construct portfolios. And I think that that's evolved further still as integration has moved more firmly into impact and engagement. Ultimately, as an investor, we deliver the best returns for clients if we actively engage with the clients we invest in and then use our capital and resources to improve their performance and behavior, the fundamental outcomes they deliver, and thus the returns we can provide to our clients.
I think that's been a big part of the ESG conversation, particularly in Australia, which is, to what extent are you able to engage with these companies and change their ways, and especially taking that active approach. And I believe it was somebody else I spoke to from AXA who said active management is the only way to deprive bad actors of capital and ensure that good actors have it. Now, with the growing number of ESG options available, and this is another big conversation in Australia, the nature of greenwashing, what do advisors need to look for when assessing that, increasing number of ESG options?
So when you're assessing those options that are available in the space, I do think you have to distinguish between a couple of categories. I think there are the highly thematic funds which seek to directly target specific issues or sectors like gender diversity or health and well-being. And then there are the more core-like offerings which do talk primarily about seeking some robust investment outcome or return, but do try to integrate ESG considerations into their investment decision making. And I think that's where perhaps the risk of greenwashing is most prevalent. I mean, there's been a huge growth in options in both spaces, both impact and more integrated approaches, but it is in that latter space where advisors might want to take particular care. And I think that is because it can be relatively easy for fund managers to adopt quite simple approaches. You exclude a few stocks or sectors, you put a little bit of ESG polish on the final portfolio, but I don't think that actually meets advisors or their clients' needs and aspirations. So I think what advisors need to look for is the level of commitment that fund managers demonstrate to responsible investing, both in terms of their own investment process and their own businesses. In terms of their processes, is ESG an afterthought, or is it tightly coupled with their investment decision making? I can give you an example in our own fund. So we talked about thinking about high quality investing, high quality as a factor. When we talk about that and trying to target companies with high earnings quality, we think that there's a connection between the diversity of a company's leadership team and its ability to deliver profitability, to deliver a profitability moat, to deliver sustainable earnings. So we actually build diversity metrics into our investment models. I think that's an example of how you can tightly integrate RI into the actual decision-making, investment decision-making. And then you can look at a fund manager's business. What sort of commitment are they showing to responsible investing? What sort of resources and expertise do they have in this space? Is it just a handful of RI funds that they offer, or do they integrate ESG in everything that they do? So for us, when we talk about responsible investing, we don't talk about it as something distinct or separate. For us, responsible investing is simply investing.
Casting our eyes back to 2020, and we do know that a lot of ESG strategies outperformed the market simply because they didn't have exposure to a lot of things that suffered quite badly as a result of health restrictions and the global lockdown. How did the strategy perform, and what were some of the lessons that you thought you learned for the future?
So as you say, I certainly think the sustainable features of the fund, of the strategy, certainly helped us, albeit that the low volatility, high quality aspects were a bit of a double-edged sword, because 2020 was a bit of an acid test for the fund and its ability to provide that drawdown protection. As the pandemic took grip in the first quarter, markets fell precipitously, and the strategy did exactly what was intended. It provided that drawdown protection. It was down overall, but significantly less than the market in that period. And then as markets recovered over the rest of the year, the fund delivered positive returns, albeit less than the market, because as vaccine euphoria took grip, it's not a great environment for defensive strategies with a low beta less than 1. It's the type of environment where you'd expect to give back some of the excess outperformance that you might have gathered earlier in the year. But nevertheless, the fund still remains ahead of benchmark since inception. It's delivered returns in excess of 13% a year, which, set against a backdrop of strongly rising markets over that period, is something we feel proud of. I do think there are some things that we can learn and some things that we've evolved and changed. One very practical thing that we're examining right now is how we measure and estimate market risk, market volatility. We're building a more dynamic measure of risk that responds to specific local market conditions and then adjusts between shorter term and longer term views of volatility, looking at risk measured over days, weeks and months simultaneously. And those types of consideration were crucial as we experienced the sharp swings in markets and sentiment that we saw in 2020. But then another thing that I think we found interesting is seeing how the impact of the pandemic didn't fall evenly across the market. I think the idea of COVID winners and losers was always to be expected, and hopefully we're certainly going to be talking more about vaccine winners and recovery stocks as we look to the future. But beyond the immediate impact of the pandemic and the potential recovery, we're also observing some very specific structural shifts in markets, and not least of all is the high levels of profitability that some companies are able to sustain. it may indicate a less competitive world, and it certainly means that the impact of the crisis didn't fall evenly across the market. Normally, when you see crises like the one we've just experienced, you get a flight to quality, but those safe havens have evolved and shifted. Today, it's the mega cap stocks of the technology sector with their mountains of cash and their profitability moats that provide those safe havens, those safe ports. So as we look to the future, it's leading us to evolve how we think about profitability, quality, defensiveness, and the types of stocks that we invest in. I would also voice one last note of caution. I do think there are some salutary lessons that we can learn from looking at the last market crash, the one associated with the financial market crisis. And we should keep that in mind. As the world emerged from that crisis, it sparked a decade of inequality, with individuals and small businesses being disproportionately hit. I don't think those themes have gone away, and this may further underpin the competitive advantage of larger companies, but it might also create opportunities for those corporations that are able to democratize access to healthcare, access to technology. And I think it also underpins the needs to not just consider responsible investing, but to actually set out to be a responsible investor.
Now, maybe asking you to look into your crystal ball slightly. I think ever since the volatility of March, April, people have been kind of flipping a coin and saying, will this repeat? Either through the vaccine rollout or due to renewed or different strains of COVID-19. What's your outlook for the market? Do you think it's going to be smooth sailing from here until, 10 years from now when we do kind of, as is expected, have another recession?
Certainly I think the one thing that you can be certain of is uncertainty itself. And you see that reflected in the very heightened levels of volatility that we saw, not just at the start of the crisis, but even as we come out the other side. There are as many stories of hope and optimism as there are voices noting caution when it comes to the speed of recovery, the speed of vaccine rollout. And to some extent, I think that underpins the need to take a more defensive approach. If you can deliver similar levels of market return with less total risk, that's an attractive offering in these types of times, and that's what we're setting out to do. You want to do it in an intelligent way. You want to think about the evolving nature of risk. Where does quality come from? You don't just want to look at price volatility. You do also want to look at earnings volatility. But as I say, I think it's meant that there continues to be demands for this more boring, less exciting way of investing that we've adopted in our fund.
All right, well, Gideon, thank you very much for joining us, and again, all the way from London this morning and this evening for us. But really appreciate the chance to chat with you, and I hope that we kind of get to continue these conversations in the future, and markets do take the path that you just discussed, and we don't see that kind of extreme volatility again.
Thank you very much. It was good to speak to you, and hopefully we'll one day get to do this in person again.
Oh, wouldn't that be the life? Thanks again, Gideon.
Thank you.